Okay, everybody, this is the last day I have as expert of the week with the Greek week, and I hope you all got to learn enough about them to help you out when choosing which option you would like to buy for calls or buying puts. We are going to cover selling puts in this video, but I just want to do a quick refresher on the Greeks as a whole. So we have theta, which is the one that takes away your profits and values over time as you get closer to expiration date from the purchase date. Delta is the number that's going to show you how much money you can gain per dollar move of the stock, right? And it's also the predictability that you'll be in the money by the expiration date. It's the same number. So if it's 0.65 delta, it's going to be 65% and $65 move per dollar share. On top of that, you have gamma. Remember the gas, the fuel, the fire, the buddy. Gamma helps out delta by increasing its value. As close to the money as you are, delta is higher. Farther away, gamma is higher, closer to the money. Farther away, gamma drops off a little bit more. It doesn't hurt you, it just doesn't help as much when you're farther away. Okay? And then you have Vega. Think of Vegas, craziness, volatility, fun, right? So Vega is the number per dollar of the percent move of IV, implied volatility, not dollar move at that one. So Vega changes it from dollar move to percent move, right? So you would like to buy an option that is lower volatility to help you out, because as volatility goes up, you're going to gain the value that Vega says. So if it's 0.02 per percent, it's $2 per percent, right? Okay. And then rho, like we said, rho is not very important to pretty much anything except for leaps. And even then, it's negligible. Okay. There we are. Moving on quickly to selling puts and wheel strategy. All right. We had covered calls yesterday. That's where you have the shares and you're offering them for sale at a strike price that you've chosen in hopes, to be honest, it doesn't get sold, right? It's your contract remains, the stock doesn't rise into your strike price and therefore is required then at expiration or when the buyer wants to assign the shares at that point. Now it behooves the buyer to wait for the stock to bypass that strike point good enough where they get those shares at a sale. You, as the person holding the shares, you don't get really anything for it at that point. That's why covered calls are important, to make sure that you're hoping and you're doing your best the stock is not going to rise into your strike price by your expiration date, okay? Now, in the inverse side of things, we have selling puts. And all this is crazy because you have buying puts and you're selling puts and you're buying calls and you're covering calls, and then there's other names for all of these too, right? So the one thing I will touch on, speaking of weird names, is Poor Man's Covered Call, PMCC. It's a way to cover a leap call by gaining some profit back on a premium by basically using the value you've paid as a premium, because if you're buying a year's worth of a call, it's going to be pricey. So you're kind of using the debit of it by then getting some premium back. So it's a way of holding a covered call without having 100 shares. You can have one leap call and still get a little bit of that premium as a covered call by doing a long-term call covered by the premium you've paid in. It's not extremely common in our group. It seems like our Discord is more quick-paced, holding a lot of shares, over time or whatever. So there is that. There's the Poor Man Covered Call, which is based on the amount you've paid in being your value, and then you do it that way. It can be sold off just the same way. Okay. All right, now, selling puts. Selling puts is the exact opposite of covering a call. You're holding the cash, right? You have to have the money to buy 100 shares of that stock. You don't need to buy the shares yet, but you have to have the collateral. You have to have the cash. So if you have Snapchat at $10, okay, you'll need $1,000 to cover 100 shares of Snapchat. Now it's going to vary. So the system will tell you how much you need to cover for collateral before you actually make you close the deal, right? So the idea is that you're going to need cash up front to cover the potential that you'll be assigned by holding the put, okay? So there's a wheel strategy here. Covered call, you have the shares. They get sold off, okay? You want to go and buy in again, right? So you're going to hold a put. You're going to sell a put, which is really your right to buy that stock at the lower price, assuming the stock goes down and you're assigned those shares. That's why you need to have the collateral up front saved, so that the system will just boop, go over and buy those shares for you at that strike price, okay? Once you obtain those shares at that strike price, which you're hoping is the lower part of the value, so you gained some shares at a valuable price point, you get the shares, and then you can flip it back again over the call, right? So this works best, the wheel strategy works best with a slightly gaining company that doesn't make big swings, isn't necessarily flat, because you want some volatility inside of that. Otherwise, all the deltas and the gammas are lower, volatility is lower. And I think of Ford. Ford doesn't, at least recently, hasn't really moved much. It's between like what, 850 and 1050. It would be a decent one that you could do a wheel strategy on, but I just looked today for covered call on it. Unless you're going to go out 6 weeks, you're not making much per contract. It was like $15 to hold a covered call on it. And I think inversely the same thing for selling a put. So you're not going to be making a lot of money per contract. So unless you're holding 20 contracts, then you'll be okay. But for a lot of us, we're going to be holding maybe 500-600 shares at most, and so that's 5 contracts. It's okay. It's not going to be life-changing. But I mean, if you have some cash and you want to put into Nvidia, something big, right? Those are going to be some serious premiums you're going to earn on both covering the call and by cash securing your put and selling the put. Now, if your goal is to not obtain shares, you just want to get the premiums, then you need to actively manage the account and make sure that you're not going to enter that strike price. So you don't, if you're holding the shares when you're doing covered call, you don't want it to get into that strike price, because you could lose those shares to the buyer. If you're selling a put and getting those premiums, the same thing. If it crosses into that strike price, you will then be required, per the idea of what selling a put is, to obtain those shares. That's why you have the cash collateral to do so. All right. I'm going quickly, but that's pretty much it. It's just, one is you've paid up front for shares. The other one is you're holding an escrow type of deposit for the shares in case you are assigned. Now, if that price is call put and the stock just floats in here like this, or just slightly up, you'll help out your put, right? As it gets farther from your put, you do better with your premiums. But then it kind of hurts your call, because your premiums go down with the call. And then if it does this, same thing, right? It's just going to be inverse. You can run a covered call and selling a put on the same company, holding those shares at the same time. There's no reason you can't do that. It's just your covered call might hedge a bit of a downside turn. So if you're losing share value, your premium for the covered call will go up. It won't be 1-to-1, but it helps out something, right? More than nothing. Green is green. And as it's doing that, if you're holding a sold put or selling a put, you're going to be gaining on that side as well, as long as it doesn't cross the strike price. All right. Now again, the closer you get to that strike price with a selling put, you'll lose that premium off too, just like you would do with a covered call. So your best idea is to have strike prices you've chosen to be far enough away from that middle at the money point that it doesn't get too close to either one of them before the expiration date. Now, if you're, I actually did this today. I didn't think Ford was going to go up to $10. We were kind of down today. So I sold a covered call. I've got over 100 shares of Ford. I sold a covered call for $10 and I was going to hold it for 2 weeks. Started going right toward 10. I'm like, okay. So before I lost premium on it, I just bought it right back. So, and I didn't want to lose my shares. I figured by it's Friday, the person holding my contract might, if this goes above 10, let's say 10.25, I don't know where it's going to go. They might be like, ooh, I got 25 cents extra as a sale. And so they buy all my 100 shares. And then I get a little bit of a loss for the lower strike price and also lost premium, right? So I ended up just canceling it. I sold it back for, I think it was like $5. Whatever. So that happens, So your best values for selling a put for premiums is going to be right strike price, right by the money. That's your highest premium, your highest risk. Farther out you hold that contract, just like with covered call, is the highest premium again. Now, if you're holding shares and you're totally fine with selling them off, you've made a bunch of money on it, and a little bit of a difference as a sale to that buyer is not a big deal to you. And heck yeah, sure, no risk really then at that point. You might as well hold it for a month and then see what happens. And if you got enough shares and contracts, you can stagger them. So every month, if it doesn't hit your strike price, you're pulling in those premiums. Boom, boom, boom. Same with selling a put. You have enough capital to put in the side, and they hold it for you in case you're assigned the shares, and you don't get assigned, and you have them laddered out every week in past 4 weeks, 4, 5, 6, 7, 8 weeks, and as you come into that week, you have more and more. That's how people do the wheel strategy and create a roving income, is by laddering these covered calls and selling puts weekly past the month. So say today I was going to start doing that. Let's say I've got 10 grand and I want to start doing that. I would buy a chunk of the shares and then start covered calling them at 4 weeks, 5 weeks, 6 weeks, 7 weeks, whatever, right? And I would also take the rest of the money and I would put it into selling puts. So the cash secured collateral put. And I would do the same thing, 4, 5, 6, 7, 8. And by doing that, you collect both ends premiums as you expire worthless. Worthless into the sense of the buyer, right? Because you're holding the contracts and the strike prices don't meet, you gain those premiums every Friday, payday. And then with selling puts, if you do get assigned, honestly, you have that kind of money, it's okay, because you're just going to get those shares at the discount. Same with well, not really covering call, I guess covering call. No, you would sell the shares at their discount, and you would lose a bit of that. If you were to buy a call and then it goes above that, and you're assigned the call by buying a call, then you get those shares at your discount. So everything that happens with options has an inverse, right? We have an inverse effect. If I'm holding the contract and I'm selling it, there's a buyer, and the premiums I'm receiving, they're paying, right? It's kind of a collateral thing. So that's how this works to make money on contracts. Is the sellers, or if they're losing because the market's going the other way, collectively they're paying the premiums of the buyers. That's just how this works. I know a lot of us know that, but for those who are new to this, watching this video, that aren't sure, that's there's always an inverse side to these options. All right, so we're at 15 minutes. It's the last one of the week. I wanted to make sure you all understood the differences between covered calls and selling puts, because these names are weird, right? As the market's finances, they try to make it confusing so that you have to go to school and take Security 7 tests just to do this, right? And you don't have to. I'm just kidding. No, you should do all of that stuff if you're going to be a professional, of course. But in the meantime, for us retail traders, we can learn enough to, putz around and do it. There's a lot of people out there that have just learned it, perfected it, and they've retired with it. So, of course, none of these videos are financial advice. They're educational, and there's always bits and pieces that I've missed that are strategies behind it. And there's a lot more. There's iron condors. There's spreads. There's a lot more to this than what I'm just trying to tell you. But those are quite advanced, and it's just much more to it. So for the basics of Expert of the Week for this Discord here, I think this is sufficient, and maybe we'll add more of those complexities as we go. But I wanted to try this out for myself, the videos for myself, and see what you guys like to hear. I was told today that they wanted to see the wheel strategy. That's why we talked about that. And that's it. It's fun. It takes money to make money in most of the cases, right? You need the money to buy the shares, or money to cover collateral to then get assigned at the discount. But it's possible. Little bits get a long way, right? The rabbit and the hare story. Slow and steady wins the race. And Mo always says, get rich slow with Mo. So I think that's it. I'm going to go. We're just pushing the 17 minutes. I'm sorry for a bit longer than usual. I will see you in the Discord. I'll see you in the chats. And of course, the Greeks Creek. I can't. It's my own channel, and I can't even say it right. Greeks Creek. I don't know why I'm saying Creek. Too many E's. Greeks Geek channel. Yikes. It is Friday, right? I'll be there posting up some plays, some charting, anything that I can find. This week's been a bit tough with everything going on at home, plus the videos to do much else with that channel. But I will do my best to put things in there. I've got a few plays going right now where I've taken a picture of the Greeks beforehand. Hopefully I will get in the money with them, and I will show you what the Greeks look like deeper in the money. Okay, so we can do a little comparison with those two. I'll post my link for the Learners to Earners upgrade just below this video, for last chance to for my link to upgrade into the Learners section. We did just upgrade the server so that learners do have access to the chat options chat room, and so now you can see what the bigger players are doing. People running chat options. My goodness. Options plays, chatting about it, and you can see what we're doing in there. Ask questions. Anybody ask questions, of course. General chat. You know the works. And then upgrading to Earner, you have access to all of the tools, indicators, the expert panels. There's like 7 or 8 of us, something like that. And I'm sure we'll be adding more. And it's going to be a wonderful time. So come on over to the Earner side if you're a learner. Give it a chance. And of course, there's also the courses that Mo has out there, and I have a discount code for now for you, so tag me or DM if you want to and ask for that code for the courses. It takes $400 off of the price, so that brings it to mid 200s for the technicals and the options mastery courses, and then the bundle it takes it about 50%, so mid 400s. All right, that's it. I thank you so much for the week. Thank you for watching all these videos and watching me progress from the RV in the mountains all the way out here and adding in these fun little features to the videos. I thank you for coming along with me, and I will see you out there in the Discord.